So you're thinking about buying a home and you're wondering, what credit score do you need to buy a home? Or what credit score do you need to get approved to buy a home? Or what credit score do you need to get a good interest rate? Well, in this video, I'm going to walk you through the exact credit scores you need to get one of the four main mortgage products: conventional, FHA, VA, and USDA. And then we'll talk about the score that you need to get the best interest rate. And if you stick around to the end, I'll share with you why you have 3 different credit scores and why the credit score you see on your app is never the same score a lender sees when they pull your credit. If this is your first time to this channel and you want to know everything about financing a home purchase, then subscribe below, tap the bell for notifications so you can be the first to know about updates to the mortgage financing world. My name is John Ritter with Ritter Mortgage Group, and we get calls and emails every day from people just like you looking for help on financing their upcoming move, and we absolutely love it. Whether you're moving in 9 days or 90 days, give us a call, shoot us a text, or send us an email. All of that information is in the description below so we can help you make a smooth move to your next home. So, what credit score do you need to buy a home? Well, it depends. It depends on the loan program you're going to use. Now, the 4 loan programs that we're going to talk about today break down really into 2 categories. The first category is the bank lending you the money all by themselves and therefore assuming all of the risk by themselves. And this is what we call a conventional loan. And this is why many times it's harder to qualify for a conventional loan because the requirements are more strict. The other category is government-backed loans, which cover FHA, VA, and USDA loans. Now, in this category of loans is the bank working together with the government to make that loan available to you, the home buyer. Since they are sharing the risk, it's a lot easier to qualify for one of these programs. So for example, with the FHA loan, it's the bank and the Department of HUD working together. With the VA loan, it's the bank and the Department of Veterans Affairs working together. And with the USDA loan, it's the bank and the Department of Agriculture working together to provide you that loan. Now, the bank is still the one that's actually lending the money. But what's happening here is these different government agencies are saying to the bank, if you underwrite these loans to these rules, then we will guarantee or we will insure you in case of a loss. So in other words, if the bank follows those rules and they lend you the money and you stop paying on the mortgage, well, the bank has to now foreclose. And if they do not get back all of the money that they are owed, the government agencies are going to step in and make up the difference through what's called their reserve fund. Now, with that said, let's take a look at each one of these programs individually, starting with the conventional loan, which again is the bank lending you the money all by themselves and therefore shouldering all of the risk by themselves. Now, technically, you only need a credit score of 620 in order to meet the credit score requirement for a conventional loan. Practically, your interest rate is going to be so terrible that you're not going to want to use a conventional loan to buy your home. On a conventional loan, the interest rate you get is based on 20-point credit score tiers. So the top tier is anything that's above 780. You get the same interest rate if you have a 780 score or an 820 score. You get the same. But the next tier down is 760 to 779, and then the tier below that is 740 to 759, and then the tier below that is 720 to 739, and then 700 to 719, and it continues all the way down to the last tier, which is that bottom tier, 620 to 639. Now what's happening is each tier that you drop down, your interest rate is going up and up and up. Now generally speaking, when you get below 720, and the further you go below that, the interest rate has changed enough that FHA financing is going to have a better interest rate and your monthly payment is going to be more appealing under the FHA program. Now there is one little caveat to this. If you have 40% down, there's going to be no adjustment to your interest rate because of your credit score. So the reason for that is because you have put down enough money to offset the risk that's created by your credit score. So theoretically, you could have a credit score of 625 and you're going to get the same interest rate with someone that has a credit score of 825 because you put down that amount of money. Now, let's jump to the next program. Let's look at an FHA loan, which again is the bank and the Department of HUD working together and they are sharing that risk, and whenever there's less risk to the bank, your interest rate's going to be better. So on an FHA loan, you can have a credit score of 640 or 740, and you're going to get the same interest rate. That's very different than a conventional loan, and now you see why people gravitate towards the FHA loan when their score is not in that top conventional credit tier. You can have a credit score as low as 580 on an FHA loan, but anything between 580 and 639 is going to impact your interest rate. You can even have a score as low as 500, but now not only is your interest rate going to be impacted even more, but you're going to most likely have to put down a minimum of 10% instead of the usual 3.5% required down payment. Now, if you're a veteran or an active duty service member, you can apply for a VA loan, which again is backed by the Department of Veteran Affairs. And so it's the bank and the Department of Veteran Affairs working together, sharing the risk, and anytime there's less risk to the bank, the better the interest rate's going to be. And just like on that FHA loan, you can have a credit score of 640 or 740, you're going to get the same interest rate. When your credit score goes below 640, then there's going to be some adjustments made to that interest rate. Now, technically speaking, the VA loan does not have a specific credit score requirement, but in order to get approved at those lower credit scores, say in that sub 500s range, you need to expect to come up with some money to put down. Now this takes us to the USDA loan, which is the bank and the Department of Agriculture working together to give you the loan, and it's pretty similar to the FHA loan and the VA loan. You're going to get the same interest rate whether you have a 640 score or a 740 score. The difference with this program is that even though there's not technically a required score to get approved for the USDA loan, it is very difficult to get approved with any credit score below 620. You're going to see an adjustment made to your score or made to your interest rate if your score happens to be between that 620 to 639 range. Now, one very important disclaimer. Even though you may meet the credit score requirement for the program, that does not mean you're going to be automatically approved. There are other factors that come into play, and the credit score is just one big part of it, but it's not the only thing to determine your approval. Now, if you want to learn about more about the other things that go into your loan approval, check out a video that I did on that topic, which I'll post down below in the description. Okay, here's the bonus information for sticking with me till the end here. So why do we all have 3 different credit scores? What's up with that? Why are my credit scores so different between Experian, Equifax, and TransUnion? That's a great question. Now, the answer can be for a couple of different reasons. First, you got to understand that these are 3 totally separate companies, 3 different entities that have nothing to do with each other. They don't share information together, they don't get on conference calls together, and that's the number one reason why you're going to have differences, is because they're 3 totally separate entities. Now, if you think about it, this is actually a good thing. There should be 3 separate entities. Otherwise, you would just have one credit score. And whatever your score is, you're going to be stuck with that one score. Now, we have 3, and so the banks choose the middle score out of the 3. So that's actually kind of giving you the benefit of a doubt in case you have lower scores. Now, the other reason that there are going to be differences amongst these 3 credit bureaus is because they have different scoring models that they use, different algorithms that are slightly different. They take into account the same facts, the same late pays, the same credit history, the same balance to limit ratios, things like that, but they compute them just a little bit differently as well. So for that reason, you're going to have some deviation in the credit scores amongst the 3 credit bureaus, and that's if they were all getting the exact same information. But therein lies another point. Why they're different is that they don't get all the same information. There's very few accounts that are required to be reported to all 3 credit bureaus. Usually it's just the mortgage. So beyond that, you may go to a bank to get your car loan, and they may only choose to report to TransUnion, or they may choose to only report to Equifax or Experian, but not TransUnion. One of the 3, 2 out of the 3, maybe not 3 out of 3. And so because of that, you're going to have a difference in your credit scores because you're having information reported to 1 or to 2 of the bureaus and not to the 2nd or the 3rd one. So that's another reason that you might have different credit scores. On that same note, you could have something negative reported to just one bureau. A lot of collection companies are only reporting to one credit bureau because you have to understand, for a creditor to report to the credit bureau, it costs them money. They have to pay for it. So if they don't want to pay to report to all 3 credit bureaus, they're not required to. They may only stick a collection on your Equifax report, which is going to have your Equifax score then much lower than your Experian or your TransUnion score. So again, a few different reasons as to answer your question of why are my credit scores different between Experian, Equifax, and TransUnion. So just to recap, number 1, they're 3 totally different separate companies. Number 2, they might be getting different information. And number 3, they're going to be computing that information differently. So hopefully that clears things up as to why you have 3 different scores. Now let's talk about why your app says you have one score and lenders get a completely different score. I get this question at least once a week. Now you might be a little bit confused about why is there a difference in the score that I pulled online versus the one that your lender pulled, and that doesn't make sense. Well, the reason is because you don't have access to the credit scoring algorithm or the formula that was used to make your score that the lender pulled. You only have access to the consumer scoring algorithms. It's really confusing because the lender just pulled a version of FICO that you can't pull. What you can pull are different versions of FICO, but they're going to be consumer models and they're not going to be the same formulas that the banks use to come up with their credit score. So let me tell you this. The end-all be-all credit score, the one that you have to pay attention to, is the one that your lender pulls, because that's going to be the one that determines whether or not you can get the home that you're looking for. So, sorry to tell you this, but there's no point in arguing that your Credit Karma score is this number. It just doesn't matter. And again, the reason why you're getting that different credit score is because it's playing by a different set of rules. It's adding up your credit score and the factors that go into it differently than the one that your lender is pulling right now. If you have any questions about this, let me know. But again, I just want to reiterate, your loan officer is not trying to pull a fast one on you. They don't get paid anymore if your interest rate is higher, and nor do they want that. They're just trying to show you and let you know the score that they are pulling and what their underwriters are going to use in making a decision. Okay, we've talked about the credit score you need in order to purchase a home and how that works for the 4 main loan programs. If you'd like a custom-made mortgage plan made specifically for you and your situation, give me a call, shoot me a text, send me an email. All my contact information is down below, and we'll put a plan together to maximize your credit score so you can get the best interest rate possible. And if you found this video helpful, please give it a thumbs up, share it with your friends and family, and don't forget to subscribe for more mortgage insights. Until next time, happy house hunting.